nearly 2.3%. And in Asia, the Japanese Nikkei dropped 0.7%. The Chinese Hang Seng fell 0.6%. And with more on what the Syrian situation could spell for the markets both here in the U.S. and globally, I'm joined here in New York by Max Wolff, Chief Economist and Strategist at ZTWEALTH, and from D.C., Saruhan Hatipoglu, CEO of Beri Consulting, and of course, my co-anchor, Phil. And Max, we're going to start off with you. So we have Defense Secretary Chuck Hagel telling the BBC that the U.S. military is ready to go as soon as President Barack Obama gives the go-ahead. We also have reports from NBC and other news stations that military action can happen as soon as Thursday. How likely is it that we're going to see some decisive action, and what impact will that have on the markets?
Well, thanks for having me. I think we're definitely going to see some action. I think the window for geopolitical reasons as well as media management strongly suggests either something before Thursday or something Friday morning. I don't think the U.S. wants to be hitting during the sort of assemblage for prayer throughout the Middle East on Friday night for a lot of reasons, having to do with management and image. And on the other hand, I don't think the Obama administration wants to wait to make the big news for when most of the American public turns off the news for 3 days for Labor Day before returning to pay attention. So I think we're going to have an action. The question is whether it's major or it's more symbolic, and it looks like for a lot of reasons we're more likely to see a symbolic than a major policy action here.
So given that action could come as soon as Thursday, is the sell-off enough? I mean, wouldn't you expect markets to dip even more?
I think that's a great question. I think the $64,000 question here is, are we going to get a symbolic move that shows the United States is doing something but the bare minimum because of the chemical weapons related story, or are we going to see a cascade? Because in these kind of situations, the United States has often decided to do a small symbolic surgical, but then has ended up still in the country in military involvement 10 years later.
Okay, let's bring in Phil in D.C. and see what their reaction is on that side.
Yeah, Max, I want to ask you something. You know, in the past, we've seen military action in the United States, whether it's with Iraq or something on a smaller scale, including what happened in Yugoslavia or even right now, potentially here in Syria. The markets always panic, and then once action is taken, it seems that the markets are always relatively calm. Is that the right way investors should probably be looking at this?
That's a best case scenario here, Phil, so I think it's an excellent question. The game here is, does the United States actually control what happens, or do they start the dominoes falling? And if they start the dominoes falling, we don't know where that goes. Some of the times we had a small strategic symbolic strike, it was successful, markets rebounded, and some of the time we're still in the country 10 years later with lots of treasure and lots of blood spilled.
Max, assuming we do have some kind of military action, symbolic or full-on assault, or somewhere in between, which sectors would be hardest hit in the market, and which sectors may actually benefit from this?
So I think it's a global story. I think a whole bunch of things are quite possible here. So if you have a kind of ramification of instability, I would expect energy prices to spike. This is generally good for energy exporters, quite bad for all the electrical and energy importers. On the other hand, we have a fledgling recovery in the United States and even more fledgling recovery in Europe, and this may push back. If we see oil prices or energy prices spike, it will push back the Fed's tampering and the tapering, excuse me,
right.
And that will cause a market-wide repricing of assets.
All right, Saruhan, let me bring you into the picture here. Your company, you focus on risk around the world. This is something that you are following extremely closely. Your clients, what are you telling them to do? Are they concerned? What would happen if there was military action?
Well, yes, they are concerned, but they also realize that if this is more of a probability now, it's not a possibility, this is going to happen. How it's going to happen and how long it will last is the main issue here. Now, if it is, as the Obama administration thinks that it will be, it's going to be limited strikes in the military areas in Syria. But there is again, considerable probability that this could escalate into a regional conflict.
I want to show you something. I believe we have a map of Syria and some of the waterways that we can put up. And one of the key concerns that investors are talking about, we saw the jump up in oil. You can see that there's Syria in the middle of the map. Obviously, there's water to the south of Saudi Arabia, to the north of Egypt and Libya. This is a very, very important shipping channel when it comes to oil, and that's the elephant in the room, and that's why we saw energy prices spike. Is that going to be a problem for the economy here? Is that going to be a problem for economies around the world who depend on that oil flow?
It's going to be a problem everywhere. Let's be sure about that. It's going to be a problem in developed countries. It's going to be a problem in emerging markets. But I want to say something about oil prices. Now, oil prices did not rise because of this threat of military action in Syria. It's been going on. It started in July when demonstration in Egypt started. Let's not forget in Libya. There's strikes there. There's military action. Nigeria, rampant oil.
When you look at that map, what is the worst case scenario you're telling your clients?
The worst case scenario that we hope would not happen is this limited strike turning into a regional conflict. At that time, if that ever happens, we're going to look at a very weak stock market. We're going to look at macroeconomic fundamentals change in emerging markets as well as developed ones.
Saruhan, Michelle here in New York, and I have a question. Why now? Why are we drawing the line between chemical weapons as opposed to bombs or other kind of attacks? The Wall Street Journal came out with an article today saying that this is an Iran proxy war and that this is potentially a way to kind of retaliate against Iran. What are your thoughts on that?
Well, there's a geopolitical strategy part of it, Michelle. You're absolutely right. But at the same time, the U.S. government put a red line. Now, if that red line was crossed and U.S. didn't respond, that would be sending a message to Iran as well. And Israel is going to be very nervous about that message. That means if nuclear arms, which is a red line, well, if you didn't do it for Syria, what makes us think, Israelis will think that you would actually help us if Iran goes ahead with the nuclear ambition. So this has to be done. Again, it's not a possibility, it's a probability at this point. It's going to happen within 48 hours.
I want to bring it back to Max over here in New York. And Max, is Syria really just an excuse for a pullback? Markets have had double-digit rises. We've been calling for a correction. Is Syria just one factor here? Or how much attention is the market paying to other elements like Fed tapering? And of course, we've got the U.S. debt ceiling, which has reached its limit mid-October.
Well, certainly we have an avalanche of potential risks coming the way of global financial markets across September, whether it's the debt ceiling or the German elections or the European forecast, a lot of things being pushed back in Europe ahead of those German elections. That being said, Syria may have been an excuse, but there's also a traditional return to paying attention to geopolitics after the summer is over, and there's going to be an awful lot, a big wall of worry